Right now, as you watch this, trillions of dollars are moving invisibly through walls, under oceans, and across borders. In milliseconds, no trucks, no vaults, no physical cash, just signals, algorithms, and institutions so powerful that when they fail, entire economies collapse. The global banking system controls more wealth than most people can comprehend. The world's 1,000 largest banks alone hold $164 trillion in total assets. That number is so large that if you stacked $164 trillion in $100 bills, the pile would reach the moon and back more than 600 times. But here's the question nobody really asks: who controls that money? How does the system actually work? And is it working? For you to understand where we are, we have to go far back to 11th century Italy. Medieval Europe was a trading powerhouse. Merchants from every corner of the continent flooded into cities like Pisa, Venice, and Genoa to buy, sell, and negotiate. But there was a fundamental problem: no unified currency. In a single marketplace, you might encounter 7 different types of coins, all with different values, weights, and levels of trust. The solution came from money changers who set up wooden tables, bancos in Italian, in the open marketplaces. But these early bankers were smarter than just swapping coins. They noticed something powerful: of their depositors never came back for all their money at once. Genoese merchants pioneered cashless payment, written promises that could transfer value across hundreds of miles without a single coin changing hands. Banking networks stretched from Italy to Spain, France, England, and beyond. They financed kings. They funded wars. They built cathedrals. Fast forward to today. The wooden table is now a smartphone app. The coin chest is a server farm humming in a climate-controlled warehouse. You deposit $1,000 into your savings account. The bank pays you 2% interest. Then the bank lends that money to someone else at 6%, 8%, sometimes even higher. The difference between those two rates? That's the bank's profit. It's called the net interest margin. Without banks, most people could never afford a home, because who has $300,000 in cash sitting around? Banks transform idle money, savings sitting untouched in accounts, into active fuel for the economy. In 2025, the global banking sector is projected to generate $8.8 trillion in net interest income alone. But here is the uncomfortable truth that most banks would prefer you didn't think about too hard. In the early 2000s, American banks discovered they could bundle home loans together into complex financial products and sell them to investors worldwide. So banks began lending to people who had no business borrowing, no income verification, no meaningful down payment. Ninja loans: no income, no job, no assets. In 2008, Lehman Brothers collapsed virtually overnight. Stock markets fell off a cliff. Housing prices imploded. Millions lost jobs, savings, and homes. Governments stepped in with emergency bailout packages worth hundreds of billions of dollars. Taxpayer money used to rescue the very institutions whose recklessness caused the disaster. And the bankers responsible? Many received bonuses that same year. Then came the challengers. For over 1,000 years, if you wanted to store, borrow, or send money, you needed a bank. That is no longer true. Revolut launched in 2015 with a mission to make banking fairer. By 2025, it was valued at $75 billion, making it Europe's most valuable startup. Globally, there are now over 650 challenger banks. While most are still finding their footing, only 92 are profitable. 24 of the largest are growing at nearly 60% per year. The fintech market, valued at nearly $400 billion in 2025, is projected to exceed $1 trillion by 2032. If neobanks were the first wave of disruption, artificial intelligence is the second, and it may be far more consequential. Banks deployed AI to detect fraud in real-time, spotting patterns invisible to human analysts. They processed loan applications in seconds, not weeks. But the most transformative development is agentic AI, artificial intelligence that doesn't just answer questions, but takes actions on your behalf. Over half of bank customers now use generative AI tools to manage their finances, and nearly all say they would switch banks if their institution didn't offer AI capabilities. And beneath all of this runs a quieter revolution, one that could ultimately be the most disruptive of all. Stablecoins. In 2025, stablecoin transaction volumes surpassed $700 billion per month. 9 European banks announced plans for a joint euro-denominated stablecoin. The walls that once separated the banking world from the digital asset world are coming down. And in the developing world, stablecoins and mobile payment systems are rapidly becoming the de facto financial system for an entirely new generation. Banking has always been, at its core, about one simple idea: connecting people who have resources with people who need them. But the institutions built to serve that idea, many of them centuries old, are facing the greatest challenge in their history. The world's 1,000 largest banks collectively earned $1.33 trillion in net profit in 2024, record numbers. By many measures, traditional banking has never been stronger. The question is no longer whether banking will change. The question is, who will be left standing when it does?